Conversation with ET now. Alka Anbarasu from Moody's Ratings and Karthik Srinivasan from ICRA talk about why they think India's financial sector is holding up the impact of US tariffs. This is after 2 months of its imposition. Now, ET Now's Anurag Joshi also asked them about India's position versus its Asian peers and where do they think credit growth going forward. Let's listen in.
We do think that India is more resilient than some other countries in the region, and we have called out some countries that are more vulnerable to the impact of US tariffs. But we think India is more resilient. Perhaps the first factor is that India's trade exposure to the US is much lower. And within the sectors where the tariffs are going to be imposed, we do think that India's domestically focused economy provides a bigger resilience to the domestic manufacturers against the US tariffs.
See, the banking sector has a stable outlook. We're doing pretty well as compared to what we were a couple of years back.
Now, the latest commentary on India's banking sector, Alka, and you are expecting the net NPLs for Indian banks to be about 2.5%, in the next 12 months, and that compares to 2 to 3% was your forecast for the last year. Are there, given the fact that you're still pretty optimistic about the level of bad loans in the system in India, are there any red flags? Are there any risks you could like to highlight? Which could worsen and which could probably vitiate the situation?
It's really the unsecured segments that are posing some asset quality issues within the unsecured segments, and banking sector doesn't have a lot of exposure to the unsecured segments. It's much more with the NBFCs, but within the banks as well, whether it's microfinance or unsecured retail loans, unsecured SME loans, those are the areas where we do see some pain yet to come through.
Any forecast or any kind of an estimate Moody's has about the amount of capital Indian banks will require? Say, it can be like over the next 1 year or it can be over the next 5 years.
We've not published any particular estimates on capital needs. We think the internal capital generation is adequate to fund even the credit growth that we are estimating in the system. We expect perhaps low teen level of credit growth, 11 to 13%.
Credit cost is also likely to inch up slightly. On the positive side, with the fall in interest rates, banks do have a significant opportunity to book treasury profits